Hi everyone, in 2024, the GPY fell to its lowest level in 34 years. Such significant fluctuation raised an important question: why do some economies become so vulnerable to currency shock? It reflects the deep connection between exchange rate and the country's economic growth, particularly through trade competitiveness, inflation dynamic, and the capital flows. To explore this relationship, our team will examine. Before we begin, here's a quick outline of today's presentation. We will move to 5 parts: an introduction, the causal mechanism linking exchange rate and growth, the empirical evidence, the discussion section, and the last one is conclusion, where we will highlight the implication for sustainable growth in Vietnam and the key policy recommendation. First, we begin with the introduction. Exchange rate play a crucial role in shaping a country's competitiveness and trade costs. For Vietnam, the key policy question is whether stronger or weaker VND best supports sustainable growth, because exchange rate movement affect export, inflation, purchasing power, FDI, and employment. An export-oriented economy like Vietnam is highly sensitive to VND per USD fluctuation. The relationship is also two-way. Exchange rate trend influence economic growth and economic performance feedback into currency movements. Therefore, policymakers must carefully balance this dynamic to maintain stability and support long-term development. With that foundation, let's now move on to the causal mechanism behind exchange rate and economic.
Let me start with the basis of exchange rate and Vietnam exchange rate framework. We usually distinguish between the nominal exchange rate, which is simply the market price of one currency for another, and the real exchange rate, which adjusts for inflation and therefore reflects a country's true international competitiveness. Vietnam adopts a managed float regime, meaning the exchange rate is allowed to move with the market force, but the State Bank of Vietnam intervenes when needed. This arrangement aims to strike a balance between stability, important for attracting capital and managing foreign currency debt, and flexibility, which support export competitiveness. By contrast, fixed regimes offer more certainty but sacrifice monetary autonomy, while fully floating regimes can expose the economy to a sharp fluctuation. Finally, exchange rate volatility have both short and long-run implications. In the short run, depreciation can help export competitiveness but also raise import costs, creating inflationary pressure. Over time, it erodes purchasing power and slow consumption. In the long run, persistent volatility becomes a drag on growth, especially in developed economies where firms have limited hedging capacity. Empirical evidence for Vietnam shows that volatility reduces export performance and discourage. Moreover, the relationship is two-way. Strong growth attracts foreign capital and causes appreciation pressure, while downturn leads to capital outflow and depreciation. Now, let's move to the three main channels through which exchange rate movement affect the economy. The first channel is the trade competitiveness channel. When the Vietnamese dong depreciated, Vietnamese exports such as textile and electronics became cheaper abroad, boosting net export and output. In contrast, when the dong appreciated, exporters lose price competitiveness and the trade balance tends to be weakened. The second channel is the cost and inflation channel. Since Vietnam imports a large share of its intermediate inputs, a weaker dong makes these imports more expensive. This spread production costs and fuel inflation, reducing household real income. Meanwhile, an appreciated dong lowers import price and helps stabilize domestic inflation. The third and the final channel is the investment and capital flow channel. Exchange rate stability is essential for attracting foreign investment. A stable and predictable exchange rate lowers uncertainties and reduces risk premiums for both FDI and the portfolio flows. But when volatility is high, the cost of borrowing in foreign currency increase and the burden of external debt become heavier, making investors more cautious. Next, let me continue with the empirical case section.
Exchange rate policy has changed a lot since đổi mới. We moved from a fixed rate to a managed float, which means the State Bank of Vietnam allows the exchange rate to move with the market, but still steps in to prevent excessive volatility. The goal is to balance three things: export competitiveness, inflation control, and overall macro stability. There are three key moments that show how this policy works in practice. During the 2008 global financial crisis, Vietnam repeatedly devalued the dong and widened trading ban. This helped exporters stay competitive at a time when global demand was collapsing. However, this period also came with higher volatility as the SPV struggled to balance inflation and growth. In 2015, when China devalued the yuan, Vietnam also faced strong pressures. The SPV responded with controlled adjustments, small steps rather than large shocks. This protected export competitiveness while keeping market calm. Most recently, during COVID-19, the SPV focused on stabilizations. It intervened to limit volatility and maintain investor confidence. This approach helped Vietnam recover quickly and supported a strong rebound in the export. A weaker VND boosts export and short-term growth because Vietnamese goods become cheaper in foreign markets. This is especially important for manufacturing sectors like textile, electronic, and agriculture. But depreciations also raised import price and inflation, which reduced real purchasing power for households and increased production costs for firms that depend on imported inputs. A stronger VND, on the other hand, helps control inflation and support consumer purchasing power. It also strengthens investor confidence and encourages FDI inflows because firms prefer a predictable currency environment. However, keeping the currency too strong for too long may reduce export competitiveness. So Vietnam faced a clear trade-off, and this is why we don't target one direction. Here, we can see from the charts that the movements in the exchange rate generally correspond with a change in GDP growth. Periods of sharp depreciations often coincide with a temporary slowdown, mainly because of higher import prices and inflation pressure. Meanwhile, years with more stable exchange rate management tends to align with stronger and more consistent economic growth. This reinforces the idea that stability matters more than the level of the currency. So the main conclusion is there's no single best exchange rate. Vietnam benefits most from a flexible managed float, where the SPV allows the currency to move with the market, but step in to prevent disorderly swing. This balance supports both export competitiveness and macroeconomics.
At present, Vietnam continues to use a selective managed float to support developments, control inflation within the target, and stabilize the exchange rate. The State Bank has operated the open market flexibly in close combination with monitoring market fluctuations to implement decisions on monetary policy targets. History has recorded that the VND and USD exchange rate have undergone many adjustments due to the complexity of domestic and foreign economies affecting the value of domestic currency. For the strong VND appreciation, on the positive side, enterprises can reduce costs when importing equipment, goods, and raw materials from intermediary countries. In September 2025, total imports reached 39.82 billion USD, encouraging firms to import more to lower production costs and increase access. This also helps to control domestic inflation by easing import pressure and strengthens FDI confidence thanks to stable exchange rate. However, businesses exporting goods or services face drawbacks. Higher product prices make them less attractive to foreign customers. The value of imported goods in early April fell to 16.75 billion USD, down 6.9% as US tariff rose. Illustrating this impact, exporters lose competitiveness and must either raise prices or accept lower profit. A stronger currency also reduces tourism revenue as Western visitors perceive Vietnam as more expensive. For the next part is the weak VND depreciation. When the VND depreciates, Vietnam export, especially textile, agriculture, and fishery, become cheaper than foreign competitors. Domestically, imported goods become costlier, helping local firms gain competitiveness and improve living standards. Reports show that many businesses benefit from short-term exchange rate differences. However, Vietnam relies heavily on imported raw materials, so currency devaluation raises transport and import input costs, which are eventually passed on the customer. And Mr. Nguyen Văn Dong notes that about 60% of textile and garment materials are imported. This increased concern for both businesses and the government, especially for if foreign countries dealt to conclude the policy. Applying a managed float is more suitable for Vietnam because choosing a strong or weak currency depends on the period and should not be fixed in the long term. The VND will adjust according to policy goals. A stronger currency helps stabilize the economy and control inflation, while a weaker one supports export growth under the state bank.
About the exchange rate and sustainable growth, we'll go inside the key insight section. So exchange rate influence Vietnam growth through trade competitiveness and inflation and also the investment flow. So since the change, the managed float regime has allowed Vietnam to respond effectively to major global shocks, such as the 2008 financial crisis and the 2015 renminbi devaluation and COVID-19, while still maintaining overall stability, which show that the exchange rate policy is not just a technical tool, it's also a critical foundation for macroeconomic resilience and long-term development. About the trade-off section, there are important trade-offs associated with both weak and strong currency strategy. A weak VND support export, boosts short-term growth and strengthen domestic production. However, it also raises import costs and places upward pressure on inflation. And with a strong VND, conversely have controlled inflation, reduced cost of input, and increased investor confidence, especially among foreign investors. But the drawback is that it reduces the competitiveness in export and tourism. This means that there are no one-size-fits-all exchange rate. The best choice always depends on the economy. So for overall conclusion, in summary, Vietnam benefits most from a selective managed float, a system that combines market flexibility with policy discipline. There's no permanently better option between a strong or weak VND. Each serves a different purpose. When stability and inflation control are priority, a stronger VND is more suitable. And when the goal is export promotion and economic stimulus, a weaker VND can be deployed. So by maintaining a well-managed, flexible exchange rate, Vietnam can strike a right balance between competitiveness, stability, and long-term sustainability.
Now let's move on to the policy recommendation. In the short term, Vietnam should focus on stabilizing the exchange rate while preserving flexibility to manage floods, stronger foreign exchange reserve, and monetary policy that support exchange rate objective. In the long term, the priority is to reduce economic vulnerability by improving productivity, managing foreign currency debt, screening inefficient investment, expanding hedging tools, and lowering import dependence in the key industry. Together, these measures have maintained exchange rate stability and conclude our presentation. In summary, a balanced combination of short-term stability measure and long-term structural reform is crucial for sustainable growth. By adopting this policy, Vietnam can maintain exchange rate resilience while promoting a competitive